This video is one that's been requested multiple times. So what I'm going to do is I'm going to cover a topic that I know quite a lot of you are really interested about. And that topic is, what can you tell about a company by looking at its accounts? So what I'm going to just mention though, before I go into this video, is if you find it useful and you want to learn more about this topic or anything else I've covered and want to know more specifically how it applies to your own business, then all you need to do is go to naccounting.co.uk and then book yourself in for a free strategy session with myself, and we can talk about that. Also, just to let you know, we've got a quarterly planning day next Wednesday, and today's the last day you can really book onto it. So if you're watching this video today, which is Friday the 16th of September, and you want to find out how you can spend the whole day with me and my team and put a solid quarterly plan together and network with other amazing business owners, then get in touch with me today and we'll see if we can get you booked on. So I'll go into this. What I'm going to need to do is share my screen. So I will do that right now. And I'm going to show you how you can find a company's accounts and how you can look at them. So I will do that. Okay, great. I believe you can now see my screen. Okay, all right. So I'm going to go to Google and I'm going to type in companies house beta. So this is the place you can go where you can pretty much get information about every single business. That is a limited company. Just remember, a lot of businesses aren't limited companies. Some businesses are sole traders. Some businesses are limited liabilities or limited liability partnerships or partnerships. Some businesses are charities. So charities, if you're interested in that, you've got to go to the Charities Commission. But the majority of businesses you want to find out about are limited companies. So I'm just going to go in here, beta services. It's pretty much the first. Oh no, sorry, that's the very first link, company's house, and find company information. So, and then what you can then just do is click start now. To be fair, I believe there's a better link. Let me just go back a couple. What is it? Company's house. Oh right, yeah, that's a bit strange. There used to be a link. Oh yeah, there's a little sublink there anyway. So if you just go into that, you can actually find you get the search bar here, and then what you can do is you can put any company you want, just for the purposes of privacy, and I don't really want to pick a random company, so I'm going to do our company, Accounting Limited. Okay. You know what? And also, before I go into this and here we are, you just want to check the address. Also, worth checking the people that are associated with it, because there's a lot of companies out there that have very similar names. Let me just check this share is definitely working. It is. Okay, great. So there's a lot of companies out there that have very similar names. So the thing you're really looking to do is just check the people and check the registered office, just to make sure you're looking at the right business. And also remember, a lot of businesses are registered at their accountants' registered offices, so that registered office might be different from the trading name. So you'll end up in a screen like this. And actually, before I even get to the accounts, there's things you can tell just by looking at this screen, which I'm going to go into. But before I go into that, what I should really explain is, let's talk about why you'd want to look at a company's accounts online. So let's think about it this way. You're gonna do business with someone and they're asking for credit terms, and yeah, there's a lot of facilities out there where you can actually get them credit checked. The credit check is really going to come to the information on company's house as well, and look at things here. But it's worth doing that, especially if you're going to give some substantial credit terms where they'll owe you tens of thousands of pounds or even thousands of pounds. You should really have that company credit checked. But if you're just going to lend someone, you're going to do some services for someone, tell them they can pay within a month, then it's worth just doing some basic checks about that company, because let's face it, if they don't pay you, you're going to be out of pocket, and that's not good for your own business. The other thing you might want to think about as well is, if you're going to work with a supplier and the supplier is claiming to be absolutely amazing, well, check their business out online, see if that's actually true, because a lot of people you come across will say all kinds of things about their abilities, but you know, one of the key measures of a business and especially like some coaches or like marketing consultants or certain industries where they're claiming to be the very best. You want to make sure that you can go to their accounts and see that in the accounts, because otherwise you may want to think twice about necessarily using them, because they're claiming to do stuff for you that they can't necessarily do for their own business. That's a really big generalization. There can be all kinds of reasons why their business might not be doing well on paper as well. So I will go into those later. By the way, this is going to be a longer video, but it's been heavily requested, so I'm going to just be really thorough. So what can we tell by the first page? Okay, got a registered office, company status active, very important. If that company was closing down or it was being struck off or was in liquidation, it would say here. So you got to definitely check that. Okay, incorporated on, it's got a date, it was incorporated. Typically, the older your company is, the more stable it is, but that you can't guarantee that. But if yeah, you would a brand new company, it wouldn't necessarily ring alarm bells, but a more established company can come across as far more stable than a brand new company. So the age of the company is quite important. And then this bit here, I think the accounts bit here, which explains when the last accounts were done, and when the next ones need to be done. That's a really, really important bit, because if a company's accounts are overdue, for example, then well, you can actually tell a lot about someone just by their accounts. Like if the accounts are being filed on the very last day, that can give you an insight into that business owner anyway. You know, they're the kind of people that leave everything to the very last minute. If the accounts are being filed early, that can tell you something about the business owner. So like, you know, the next, so this says us as a firm, last accounts made up to 31st of December 21. So we're completely up to date with our accounts because there isn't a more recent period that we could have done accounts for. But that's really important because, and actually, when you use a professional credit referencing agency, the having overdue accounts or how close to the accounts deadline the accounts are being filed, it does actually, from what I've seen, it actually impacts that credit rating of the business. So that's just an observation you can make yourself. Confirmation statement, not as important, but definitely counts. And then what we're the confirmation statement is slightly important in the sense that if you're looking at people with significant control, you want that confirmation to be up to date, because then the actual people you can see in company's house here aren't up to date either. And then it's nature of business. You can't rely on that much because there's a category for other business, and a lot of people just use that category. But it does. I don't think that's that important. But let's just have a quick look at people before I go into the accounts. Yeah, so you got officers. A lot of people don't realize, but actually, about 10 years ago, I think they removed the requirement to have a company secretary. So you'll see a lot of businesses these days without a company secretary, and there's nothing really significant about that. And people with significant control, this will tell you about who has the majority of the shares in the business. Just bear in mind, persons with significant control aren't always people, and another company can own this company. So, and it just tells you the nature of their control, like do they own shares or voting rights? And it could be a company that owns this company. So that's something to factor in. And if you go to the More tab, there is this is where you can just buy stuff off company's house. It doesn't really matter too much. But then you've got filing history here, and that's quite an important one. But actually, usually the More tab, I believe, contains information about any charges against the company. So if you think about it, if the company's gone out and got a certain type of funding, then a charge can be applied to the company. Just like, you know, with your house, if you've got someone else who's got an interest in your house apart from the bank, they can have a second charge on your house. So companies can actually have second charges, and I believe they can have CCJs as well, county court judgments associated with the company. So, you know, if the company's got CCJs and if it's got charges against it, then you've got to ask the question why. because it can be an indicator of a higher risk, higher credit risk. So let's talk about what we can see here. This is pretty much everything we filed ever with Companies House, and you got a few different types of filing, but really the only significant ones are the unaudited abridged accounts. So what is also useful here is with confirmation statement with updates. If you're looking at a confirmation statement and it says no updates, just ignore it because there's nothing useful in there. But if you scroll back enough and you go to a confirmation statement with updates, what will then let you do is I won't actually go into that, but what will let you do is then open it up and you'll be able to see who the shareholders are of that business. So that's a really useful one. And if there's no confirmation statement with updates, what you can do is then you can go all the way back to the incorporation document, and that means nothing will have changed since incorporation, and the incorporation document will have all the shareholders associated with it and its shareholdings. So that's important because the PSC register won't, persons of significant control, it will tell you if there's a shareholder, it will tell you about any shareholders that own more than 25% of the company, but it won't tell you about any shareholders that own less than 25%. And that's significant, but the confirmation statements or the registration document will tell you about them. So if you're dealing with someone, it's useful to then understand if there's like a minority interest, because when you're dealing with someone, you want to know everyone you're dealing with. So that's what the confirmation statement does. But the most important bit and the whole purpose of the video is the unaudited abridged account. So what does that mean? Well, if you qualify for it as a small business, I believe it's a profit of less than 2.3 million, turnover less than 6 million, and less than 50 staff, and you only have to meet two of those conditions to need an audit. But if the 2 out of 3 of those don't apply to you, then you don't need to have an audit. What is an audit? It's when external people come along, go through all your books, and then provide a written and official opinion on how accurate they think your accounts are. But that's a very, very expensive process. It can, an audit can start at like 10 grand. So you don't really want to have to get an audit for your business. But if your business is of a certain size, you might have to. But most of the businesses you come across won't be audited. So that's what the unaudited means. The unaudited is relevant because it means there's no external influence on those accounts. What it means is that is purely the opinion of the business owner. And obviously they have an accountant who will be relatively honest and will steer that business owner into forming the right opinion and supplying the right information. But you can't rely on that either. So everything you're seeing there is purely the work of the business owner and based on the information they supplied, and that hasn't been validated. Okay, what does abridged mean? Well, you get two sets of accounts, types of accounts. You get your full accounts, and the full accounts say absolutely everything about your business and your finances. Those full accounts go to HMRC. HMRC need those full accounts because when they're looking through the accounts, they want to see all the detail because they want to see if there's any indiscrepancies and they want to make sure it makes sense. So HMRC will have details about all of your performance. Abridged accounts, which are only available at Companies House, what they do is they strip out sensitive information, the kind of information you wouldn't want your competitors to have about your margins, the type of customers you're working with, the breakdown of certain, well, mainly about your margins. So that's what abridged accounts do. They're like a much lighter version of the accounts where a competitor of yours can't come along and have a look at really sensitive information about your business, but there is still enough information there for a general member of the public to form an opinion about your business. So let's go into it. So Northhouse Accounting unaudited abridged financial statements for the year ending 31st December 2021. So I'll just go through it quickly and then we'll talk about what it means. So Here's table of contents. You just got the balance sheet and you got the abridged financial statements. If this was a full set of accounts, you'd have information about dividends, you'd have profit and losses, you'd have like a full fixed asset, more information about fixed assets. We don't have all of that here. Let's go through that. Okay, fine. So what got here is this is essentially the balance sheet. So yeah, the difference between abridged and non-abridged. So what you can see here is you can see a balance sheet. What you can't see is my profit and loss. So we can talk about what it means though. Intangible assets. This is anything you can't physically touch. That usually relates to goodwill, if you've ever bought a business or you incorporated it early enough. And it relates to any other intellectual property you might have. Tangible assets, anything you can touch, right? So if you've got a van in your business and you can touch the van, it's a tangible asset. Intangible means not touchable. Tangible means touchable. And what this is telling us here is it's saying what is the value of those assets at this date. So just remember, a good set of accounts, unless it's someone's first year, will usually have a comparative. So it'll say, okay, well, this is how you've done this year, but this is how it was the year before. But just bear in mind as well, though, accounts don't always run for a year. Like if it's sometimes a period of accounts could be up to 18 months long. Sometimes it could be as little as a month. So you can't just assume a set of accounts is going to cover a year. You need to check the dates and why is that relevant? Because if you're looking at figures and performance for a period you think is a year, but it's actually a few months, then your judgment, that's very relevant to your judgment, because someone achieving something in a year might not seem particularly good, but them achieving the same thing in 3 months could seem spectacular. So it's very relevant to actually factor that in. But if I keep working through current assets, so debtors, that is people that owe you money. It could be a customer who owed the business money. This is a snapshot in time, remember. So it's not about the performance over the whole period of time. It's about, at the 31st of December 2021, what was the position? So who owed money at that time? And then we got cash at bank in hand and in hand. This is a really important figure. So that's just how much money was in the bank account. And then you've got some totals here. And then you've also got figures for creditors, like, how much money did the business owe other people? And once you factored all of that in, what you then end up with is, so you've got other credit. So you've got two types of creditors. Creditors falling due within 1 year, so people that owed the money at that point. And then you've also got creditors falling due after more than 1 year. So a lot of businesses who got the bounce back loan, that's actually going to sit in here. So creditor amounts falling due after more than 1 year. So that's where it would go. There's things like deferred taxation. Don't worry about that. But what's really important is you've got this number here called net assets, which essentially equals shareholder funds. But the net assets is a really important one, because this is, so net assets is essentially telling you if the business is cumulatively profitable or cumulatively loss-making. Why do I use the word cumulative? Well, ultimately, the business could have been historically very profitable, and if it recently made a loss, you're not going to be able to tell that from just looking at this one net assets figure. But what you are going to be able to do is you're going to be able to tell that by if the business was always cumulative, making a profit, and now it's making a loss, you're not necessarily going to be able to tell that from the set of accounts at all, and I'll explain why in a second. Just let's do the easy bits first. Okay, debtors, what does that mean? It means people owe this company money. What does that mean to you? It means that there is some risk there, because if this company is owed a lot of money by customers, it could mean that if some of those customers default, it could cause a risk for the company you're about to do business with, and then that company that you're about to do business with could end up at risk and then pass that risk on to you. So that's relevant, right? Assets are moderately relevant in the sense that if they've got assets and there's a substantial amount of tangible assets, that can indicate a lower level of risk with a business, because it means like if they owed you money for whatever reason, you could always send in insolvency practitioners to go and seize their assets, well, arrange the seizing of their assets to then be sold off to actually pay you the money you owe. So it is relevant, but there's lots of ways those assets that sit on the balance sheet could actually disappear by the time you could get to them if you were owed the money. Okay, talk about cash at bank in hand. This means there was money in the bank account. What does it mean if you look at a set of accounts and you can't see that figure? Well, the least likely scenario is they had exactly £0 in their bank, or they had like a penny in their bank account. But the most likely scenario is they're actually in their overdraft, and that's why it's not sitting under current assets. It's more likely to be sitting under creditors, amounts falling due within 1 year. So just something to note. If that's what you can tell by looking at it, it's that if you can't see it there, it could be because they're in an overdraft. Really, really important. So let's also talk about. I'll go into creditors. There's further notes that we can look at in a minute, but we'll talk about creditors in a minute, and we'll talk about debtors in a bit more detail in a minute as well when we go into the notes on the following pages. But typically, the most important thing you're trying to establish, the most important piece of information in this set of accounts, in any set of accounts, is the movement in the net assets year on year. So the year before, there's £884 of net assets, and this year there is 5,249. What does net assets mean? Well, net assets is essentially all of the assets in a business, the intangibles, the tangibles, the debtors, the cash in bank in hand, minus everything that is owed to people. So that's the creditors falling due within 1 year, and the creditors falling due after more than 1 year. So let's say there's some growth here. I'm just going to keep it simple. There's £4,500 of growth there, right? Does that mean that the business only made £5,249 profit in the year, or well, more if the growth is at 4,500? Does that mean it only made £4,500 profit in the year? Well, a lot of people looking at this would say, yeah, sure, but there's other things you've got to factor in, right? What if it made a £54,500 profit but issued £50,000 of dividends? So if you think about it, by issuing a dividend, you're reducing the amount of money in your bank, or you're creating a creditor. So that is because it would go into a director's loan account. So that's reducing the net assets. So one thing you can't tell from the net assets is how much profit a business made in the year. In fact, you can only really tell that from the full set of accounts, which you don't have access to at the moment. But what that does mean is if you made a 54.5k profit and took a 50k dividend, there'd only be 4.5k left, and that would 4.5k would show you a movement from 884 to 5249. I know it's not exact, that's why you can't tell exactly how much profit this business made, because you don't know how much was issued in dividends, and you can't tell that from here. But what you can, you may be able to infer it from something I'm about to show you, but you can't tell it just yet. What you can tell though is that the business didn't make a loss, and the reason, what you can tell is that the business is not cumulatively loss making. So what that means is if this net asset figure was less negative, what that would tell you is the business wasn't in a position to issue dividends. Like, you can only issue dividends in business if your net assets are positive. So if this set of accounts are showing a negative net asset figure, then, and the year before it was positive, then you can almost be certain that that company made a loss in that set of accounts. Because to go from a positive net asset balance to a negative one, it means it's unlikely any dividends were issued, and it probably did make a loss. What you can also tell is if you had a negative figure the year before, and then the figure became less negative, and but still showing negative, it could be an indicator that the business made a profit. Because if the cumulative negative loss, sorry, the cumulative loss is getting smaller, that the only way to make a cumulative loss smaller is by making a profit. And you can also tell that point, if it's a cumulative loss, they probably wouldn't have issued any dividends, so it would have been they would have made a profit. So yeah, typically if you go from negative to positive, that means, or negative to less negative, it means you're making a profit. But if it's positive, you can't tell exactly how much profit was made, because some could have been issued as dividends. But if it's negative to negative, you can tell that there probably weren't any dividends, but it did still make a profit. And if it went from positive to negative, you can tell that there probably weren't dividends, and it made a loss. So I know that's confusing. That's definitely why you should come talk to me about it if you want a bit more clarity. And then here you can just see things like called up share capital, profit and loss account. So called up share capital, that's just how much has been issued in terms of shares. What can you tell by that? It's, well, you know what? The tax efficient thing to do is to keep your share capital low, if it's just you in the business, or you and a couple of people. But if in terms of your creditors, it can be very reassuring for you to actually have a larger share capital, because what it means is that you've invested money in the business, and that money that you've invested in the business, if the business were to go into liquidation, or there was any issues with it, that money that you've invested in the business would have a lower priority than the money that your creditors are owed. And that's important, because that means your creditors know that they're more likely to get paid first over and above you. Whereas a lot of people, for tax efficiency, which I guess they're right to do if they're not planning on needing too many creditors, they have low share capital, and then typically they introduce money into the business as a director's loan. So what that means is they then, if the business did get into difficulties, they would be a creditor. They would be a creditor at the same level as all their other creditors, so they'd get paid in the same proportion. So that's just something to think about. But yeah, it can be a good thing by having a larger share capital for anyone you're doing business with. So I'll move on. Yeah, maybe I'll just reiterate the bit about the net asset movement. So yeah, if the net asset movement is essentially getting bigger and it's positive, it means that the business is profitable, but you just can't tell how profitable, because it's probably the owner may have taken dividends, which you can't see here. If the amount is getting smaller but it's still positive, it means the business is either making a loss or it's profitable, and the business owner just took a load of dividends out. So that's all you can infer from that. And if the amount was negative and it's getting less negative, but it's still negative, then the business is making a profit, and it's unlikely the business owner took dividends, because those dividends would have been legal. And if the business is going from negative and it's gone to a positive, then that tells you that's made a profit, and they could also potentially take dividends, so you can't tell how big the profit is. All right, I'll move on. Okay. So, all right, actually, sorry. Here's some notes. It just says this is the director who signed off the balance sheets. And they acknowledged that it was exemption. They were entitled to an exemption from audit. Sign it off. Most of them will never be signed off, because it's all signed electronically. But some you may find, if it's like an amended set of accounts, for example, you might find a signature in here. So this is some notes for the accounts. It tells you. I mean, it's a lot of accountancy speak, but tells you some interesting things. How depreciation has been worked out. Actually, yeah, that's not interesting, but it tells you how the turnover has been calculated, what rules have been used to prepare the accounts, how taxation's been accounted for, it also tells you the average number of employees during that year. This is and this is where you get a bit more of a breakdown of the different assets and the movement in those assets. I mean, this section here doesn't really tell you a lot. I don't really see the point in it. But a share capital, that's not really telling you anything more than that was in the balance sheet anyway. So I'll keep going. There was one. Okay, actually, it's not in this set of accounts. In fact, but some companies as well. What you'll see is you'll have a breakdown of all the you'll have a breakdown of the debtors, and you will have a breakdown of your creditors. So the debtors will help you understand who owed the money. So that could typically be customers that owe the money. It could be money owed to them by HMRC, for example, if they've overpaid, especially if they're on like the CIS scheme. It could be a director that owes the company money because they've taken out more money than the company could afford, that could afford to issue in terms of dividends or salaries. So that could be money owed to them. Creditors, typically you'll have things like tax in there, suppliers to the company who are owed money. You might have director's loan account in creditors because the company has issued more in salary and dividends, or has accepted money from the director which it hasn't paid back yet. So that can sit in there. So there's quite a few factors, and then quite often, like and creditors will also include things like overdrafts and also the amount of creditors falling due after more than 1 year. That can include like mortgages or long-term bank loans. So that's really an overview of what you can tell from a company. So, but yeah, an overdrawn director's loan account. If you look at debtors and you see a director's loan account in there, that's often that can sometimes be an indicator that the company's not being run completely responsibly. Um, but that's but the main point here is the net assets. So this is essentially what a set of accounts means. So just once again, now we're going to recession. I'm just going to stop that share. The reason that you do want to just keep an eye on accounts when you're doing business with people is we're going to a recession now, which means a lot of businesses are going to get a lot more riskier. They'll be under more pressure in terms of cash flow, and what that means is they could end up affecting your business as well if you do business with the wrong people. So what I'll do is I just want to extend that offer again. So if you want to find out about this in any more detail, then just get in touch. Go to our website naccounting.co.uk, and you can book yourself in for a free strategy session where we can talk about specifics relating to your own business and anything that you're particularly worried or concerned about. And I'll see you. And if you do want to attend our QPD, just today's the last day you can book on. So let me know, and I'll get you an invite. All right, thanks for watching. It is a long video, I know, but it's really, really important. This is such an important skill to a small business owner. So I'll see you at the next video.